What do you think here? I was on the phone earlier today with an auto dealer, and they didn't have much, looking for a new car. They didn't have much inventory, particularly in the hybrid area. They don't have a lot.
Yeah, good afternoon, Tyler. Thanks for having me. You're right. Inventory on the new side is still very limited. And while we're starting to see some signs of used prices alleviating, we still think we're a couple quarters away from new production materially building enough to where inventory starts to build on lots. And, that's part of the reason we actually think the auto dealer stocks can work, because while inventory's been light, what it's led to is a much higher per unit profitability. And I think as OEM production slowly ramps and improves, that elevated profitability can last here in the near term.
It's very interesting because I was going to ask you sort of basically that. I have another friend who's in the automobile business. He said, we're not selling nearly the volume in units that we used to sell, but we're making more money than we ever have.
Yeah, that's exactly right. I mean, if you think about the historical car purchasing process, you're used to going in and negotiating some amount off of sticker price. And essentially over the last 12 to 18 months, you haven't been able to do that. And so the dealers themselves, exactly what you said, selling fewer units, but making much more per unit. And overall, it's actually been a net increase to profitability, which is part of why the stock's multiples have compressed.
Yeah, I mean, nowadays it's how much less above sticker price can I get in many cases.
That's exactly right. Especially on hard to find models, you're going to find above MSRP, and especially the independent dealer lots out there.
How do you start thinking about the recession and a pullback in consumer spending, Daniel? I mean, I would imagine that consumers who are looking for cars might be more apt to go and buy a used car instead of a new car. But are you concerned at all that there's going to be an upswing in inventory at exactly the time when consumers pull back? So there's a bit of a push-pull there?
Yeah, well, it's a great question and kind of the key for investors right now, the key focal point. I think it's a risk into next year, but I still think we're undersupplied enough on the new side that we're not going to hit that fulcrum until at least the back half of next year. We're really see supply meet demand. On the used side, there's no doubt, though, to your point, we're seeing consumer spending pull back. We've seen it much more distinctly at the used-only retailers. So out of our coverage, CarMax and Carvana are two that don't have the new side. So we've seen demand pull back without maybe the offsetting profitability from the new vehicle piece. But, in our opinion, there's enough between a few things, really pent-up demand, and that's both consumers, also rental car agencies. I mean, you had the stat, inventory or prices were up last year. Biggest driver of that was actually the rental car companies at auction buying cars. Over the next 12 months, there's still a lot of pent-up demand from those fleets to turn over and kind of become younger again. And so I think there's enough demand for new vehicles that we're not going to quite see that inventory build as much as people fear, especially with the ongoing supply chain issues, whether it be out of Asia and China, whether it be across Europe with the energy crisis. I think there's still some global disruptions that are going to continue in the near term.
As you go through and you look at the car dealership stocks, are there one or two that you like markedly more than others?
Yeah, it's a great question. There are. I think broadly for the group, we lean more positive, but our favorites in the group, all year has been Asbury, ticker's ABG. What we have here is a fantastic, really cost control story. The management team has been great executors and capital allocators over time. Through COVID, they've bought really 3 assets, and from our industry contacts, they probably bought the 3 strongest assets that were bought during COVID. I think it's made their earnings power stronger over time. And I think, they've paid down a lot of debt off the balance sheet. They finally have the free cash where they can start reallocating capital back towards shareholders. They do have some Florida exposure, so that could be a bit of a near-term just disruption with Hurricane Ian down in Florida. But I think longer term, that remains one of our favorites. Another one we've been highlighting more near-term has been Group 1. It's a dealership model that historically the ownership in Brazil and Texas have been overhangs, but they've divested Brazil. Texas right now is actually a very strong economy for them. And the stock's trading at a 20% free cash flow yield on next year's numbers, which already assume profitability begins to normalize next year. I think at this valuation, that's another one that in the near term investors could put money to work today.
Wouldn't the UK be an overhang for Group 1, though? They've got a sizable share of the market there.
It's a great point, and it is, and it's definitely an overhang on the group. I don't think the multiple fully closes that gap, but I think it's more than discounted today. The other piece is the UK for these guys is vastly premium luxury. So as you think about that consumer who's buying a new Porsche or a new Mercedes or Maserati, much less, I think, discretionary or much less impacted by the inflation we've seen. It's more fluid customer base over there.
All right, Dan, thank you very much. Dan Imbro of Stephens. We appreciate your time today.